Let's talk about that a little bit because you're absolutely right. Now we're in a market where everything is correlated to one. Bonds, stocks, oil, gold, everything moves in concert. What do you say to those that say, hey, the market's up 65, 70% from the March lows, and I'm doing great. I'm back. The economy's turning around. I mean, again, why is it that there are no safe things? Well, I'll give you the opportunities here.
Well, let's ask this question: are you really back? If you were at 1576 in October of 2007 on the S&P, you're still missing a third of your money. Mm-hmm. If you rode it all the way down. Now, if you sold out and you bought at 666, you're running high on the hog. But how many people did? Okay, let's be straight here, because most people paid absolutely no attention to folks like myself that were saying in early 08, late 07, get out, run. The bomb's going to go off, okay? Right. Nobody paid attention to that. Most of those people either sold on the way down after Lehman collapsed in the 800s, or they sold at the bottom in March.
They still aren't back in.
Yeah. And some of them are back in and some of them aren't. But here's the thing. You say, I've got a 60% gain, all right? But here's the reality that people don't talk about. If you lose 50% of your money in the market, you need to double to get back to even.
Absolutely.
Nobody wants to talk about the math.
Right.
Is a 60% rally really all that good? No, it's not when you lost 75.
How much does Bill Miller need at Lake Mason to get back to the 70% he lost last year?
Well, here's my question. How much did he lose in Countrywide that he was buying at $40 a share? All right. I mean, I was shorting it aggressively at that price because I looked at the balance sheet of the company and said that's a zero.
Yeah.
All right. I mean, I'm going to get paid on it eventually. I may have to sit on it for a while, but eventually that's going to pay.
Yeah.
What I see now, though, is really since June, from the March lows to some degree, but really since June, the correlation has been very simple. The dollar goes down, the markets go up.
Exactly.
All markets.
Yep.
All right. The problem with that is what we've done is built a carry trade. We learned nothing from Japan. They did the same thing. By my best estimates, there's $500 billion out there in dollar carry right now. Here is the historical fact with regards to carry trades. There has never been a carry trade in the history of the markets that has unwound peacefully. It's never happened. Every time they've come apart, they've blown up.
Right.
So are we really trying to fool here in saying, oh, you should buy the market because? All right, the truth of the matter is that we are in the same sort of bubblicious sort of environment in the stock market today that we were in with housing back in 2006 and 2007. The only thing that's happened is it's now a bunch of big banks that are able to borrow at effectively zero. Most of that money is going out of the United States, but some of it is reflecting back into equities and bonds and other places. You have two distinct points of view that are being expressed in the market right now. The gold market is saying there's going to be hyperinflation, okay? The bond market is saying there's going to be a deflationary collapse.
Exactly.
Why else would you buy 10-year treasuries at 3.3%? Okay, you got to be out of your mind if you think there's going to be any sort of inflation at all to buy 10-year treasuries, a 10-year commitment at 3% a year. You're nuts. So one of those two markets is wrong. The question is,
where do you think
which one is it?
Yeah, I agree.
Well, listen, the gold market, the metals market in general is tiny compared to the credit market.
Right.
In terms of capitalization, it is a tiny fraction of the bond market.
Right.
So in terms of who's got the louder voice, it's the guys in the bond market.
Yep.
Does that mean that they're necessarily right? No. But it means that when you have that sort of dichotomy, no matter which position you take, you better be hedged.
Let's explain that to people because that's a very good point. Let's look at market sizes. Bond markets are how many times bigger than the stock market? Do you have a number on your head? I don't.
Off the top of my head, no, but it's a significant multiple. It's 3, 4, 5, 10 times the size. I mean, it depends on what you're looking at. Yeah.
Gold, when it comes to bonds and equities, is a sliver, right? So.
Yeah, gold trades a couple of $1 billion a day, and the total production of all gold is something like $20 billion annually or something like that. So it turns over the entire production in mining about every 5 days.
In a week or two, right, yeah.
Yeah.
And so what we've got is basically can of gold that's being kicked, to use your analogy. I love your kick the can analogy. That's being kicked down the road because it's easy to grind and manipulate and move because there's less players, and now you're getting that fear trade going on. Hey, the dollar's crashing to zero. We're going to inflate. Whereas I'm kind of in the camp with you, Karl, that I think we're probably not going to see a new low right now on the dollar, and we probably will see higher interest rates. I don't know, though. It's to be determined. I don't know.
Gold is a very thin market, and if you need to see any evidence of what happens in thin markets when somebody shows up and wants to move them, take a look at yesterday's move in the S&P 500.
Right.
Anytime that there is thin volume and there is very little liquidity, somebody can come in there and move a market very convincingly with very little money.
Right.
And unfortunately, what you have is, you have a lot of rumor mongers out there too, all right? They're in every market. They're in the stock market. They're in the bond market. The latest one in the gold market is that there are 400-ounce good delivery bars that have been found that have tungsten cores in them, all right? I don't know if it's true or not, but, if it's not true, does it create panic? It might, and is that all you need to drive a price? Sure.
So let's talk about being a trader or an investor in this marketplace, because it is a new world in that relation. You've got a lot of strange things going on. Do you think you need to be more active and more aware of liquidity and constraints and supply issues that are out there in all markets? I mean, you really need to understand kind of what you're playing in, probably more than ever.
I don't think anyone can invest in this market at all right now. I was a buyer at or near the 666 lows. I called the corner about 10 handles off the bottom in real time. But I was buying from the 700s, the low 700s down.
Sure.
And that wasn't because I necessarily believed the fundamentals of the economy were going to improve. It's because the mantra that I have on that is the end of the world only comes once. If you happen to make the correct bet on the end of the world, you will not be able to collect.
Right.
So therefore, there's no risk in buying into what looks like a terminal decline, because if you're wrong, you're going to need your guns. Your money's not worth anything. If you're right, and that's the thing. And if it's not a terminal decline, you're going to make a bunch of money. Okay, so you can't lose that bet. In that, if I'm going to give you worthless dollars for something, then what's the risk? Okay,
Yeah,
I mean, I've taken no risk.